Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know first Fed chair race shaken as hawk. Larry Lindsey withdraws, boosting market hopes for a dovish successor. We'll examine how his public criticism of the political process threatens Federal Reserve independence and market stability. Second, UK seals landmark India trade deal to close its £8.4 billion deficit while confronting Modi on Russian oil. Today, we'll take a closer look at this pragmatic diplomacy and its implications for the UK's post-Brexit strategy and alignment with the West. Third one, £0.5 billion Chinese wind farm deal in Scotland creates 1,500 jobs but faces major national security objections. We'll explore how this deal tests the UK's national security laws and could create major trade friction with the European Union. The race to lead the Federal Reserve just hit a major snag. A leading candidate to replace Fed Chair Jerome Powell has publicly taken himself out of the running, and his reason is sending a powerful message across Washington and Wall Street. Former Federal Reserve Governor Larry Lindsey has officially withdrawn his name from consideration for the top job at the central bank. Now, Lindsey is known as a monetary policy hawk, someone who prioritises fighting inflation, often by advocating for higher interest rates. By contrast, a dove prioritises stimulating employment and economic growth, usually through lower interest rates. Lindsey's withdrawal removes a major hawk from the running, which immediately makes the market think the next Fed chair is more likely to be a dove. This has huge implications for future interest rate policy. This isn't back-channel gossip. It's a direct statement. In a text message to CNBC, Lindsey stated, quote, "I have a very full, varied and enjoyable life right now that I don't want to give up to go through the mill of public life," end quote. Let that sink in. The mill of public life. This isn't just a personal choice. It's a public disruption to a high-stakes search. Lindsey's comment sheds light on the increasingly grueling political confirmation process for Fed nominees. This intense political battle can act as a filter, scaring away highly qualified experts who don't want to endure the scrutiny. The risk is that the candidate pool narrows to only those with strong political backing, which could compromise the perception of the Fed's independence, and a Fed that is seen as political rather than independent can make global investors nervous, potentially increasing the risk premium on US assets. Lindsey was one of the candidates being actively interviewed by Treasury Secretary Scott Bessent on behalf of President Donald Trump. The administration is vetting a list of contenders to replace current Chairman Jerome Powell when his term expires in May. The position of Fed Chair is one of the most powerful economic roles on the planet, with the ability to move global markets with a single sentence. This matters because of the US dollar's role as the world's primary reserve currency. About 60% of global foreign exchange reserves are held in dollars. When the Fed raises interest rates, it tends to strengthen the dollar. This makes it more expensive for other countries and companies to pay back their dollar-denominated debt. It can tighten financial conditions globally and force other central banks, like the People's Bank of China, to react. So whether the next Fed chair is a hawk or a dove has direct spillover effects on China's economy and its policy decisions. For a former governor, a serious contender, to walk away and publicly cite the desire to avoid the process itself is a dramatic turn. Lindsey's exit immediately scrambles the board for the administration. With Powell's term end approaching, the clock is ticking. This sudden departure of a prominent candidate puts the entire selection process under a new, intense spotlight. This isn't just about replacing one person. It signals a potential de-Powellification of the Fed. The current chair, Jerome Powell, is known for a flexible, data-dependent approach. The search for his replacement could mean a structural break from this policy, moving towards a more rules-based or politically influenced model. This fundamental shift is why markets are now so focused on the other contenders. Think of the remaining candidates as a kind of shadow FOMC. Their public comments are being carefully analysed for clues about the next policy regime, causing market volatility long before any official nomination is made. This isn't just about one candidate dropping out. Lindsey's explicit rejection of the public process serves as a stark commentary on the immense pressure and political scrutiny now attached to leading the nation's central bank. The search for the next Fed chair just became a much more complicated and public drama. So, what should we watch for next? With a major hawk out of the race, the odds of a more dovish Fed chair have increased. In the near term, this could be seen as positive for the stock market, as it suggests a lower likelihood of aggressive interest rate hikes. However, it could also lead to a weaker US dollar. The focal point now shifts to the other names being vetted, like Kevin Warsh and Christopher Waller. Their public statements and any leaks from the administration's vetting process will be the key indicators driving market sentiment in the coming weeks. Speaking of political pressures affecting major economic decisions, UK Prime Minister Sir Keir Starmer just met with Indian Prime Minister Narendra Modi, who has described himself as a friend of Putin. While celebrating a new trade deal, Starmer confirmed he directly challenged Modi on India's continued purchase of Russian fossil fuels, which helps fund the war in Ukraine. This high-stakes diplomacy is unfolding as the two nations forge one of their deepest economic partnerships in history. Actually, this situation perfectly illustrates a major shift in global politics. India is pursuing a strategy of multi-alignment, maintaining its strategic neutrality to engage with multiple world powers, including both Russia and the West, without compromising its national interests. The UK, in turn, is adopting a pragmatic approach. This is significant because it shows some Western powers are prioritising economic partnerships in the Indo-Pacific to build influence and create a counterweight to China, even if it means accepting a less than unified diplomatic front on issues like Russia, and the stakes are enormous. Starmer called this the most ambitious trade deal India has ever done. Here's why. India is on track to become the world's third largest economy by 2028. The UK currently has a significant trade deficit with India. In 2024, the UK imported £8.4 billion more in goods and services than it exported to India. A key goal of this deal is to close that gap. The UK is making a strategic pivot, aiming to boost its exports of high-value services like finance, education, and digital consulting to India's rapidly growing middle class. Projections show this deal could increase the UK's GDP by £4.8 billion annually by 2040. Even before the deal is fully implemented, it has reportedly driven £1 billion in new investment and created nearly 7,000 jobs in the UK, all fueled by the UK's largest ever trade delegation of more than 100 CEOs and leaders. But that's not the whole picture. The real turning point is how the partnership now extends beyond trade into governance. Starmer also met with the founder of India's massive digital ID system, right as the UK government pushes a similar controversial plan at home, a plan that has already faced a petition with over 2.8 million signatures against it. This isn't just about domestic policy, it hints at a future alignment on what's called digital public infrastructure. While aligning with India's successful Aadhaar system could unlock massive opportunities in services trade, it also creates a major strategic dilemma for post-Brexit Britain. India's model for data handling is very different from the European Union's strict GDPR privacy rules. This could force the UK to make a difficult choice between deepening its digital ties with a fast-growing Asian power and maintaining regulatory harmony with its European neighbours. In exchange for this deep alignment, the UK will cut taxes on Indian goods, like clothing and jewellery. In return, India will reduce duties on British imports like Scotch whisky and luxury cars. It's a landmark agreement that ties the UK's economic future to a rising global power, even as they navigate a major geopolitical fault line. Now, get this, the success of Scotch whisky exports will be a crucial barometer for the entire deal. The agreement will slash the massive 150% tariff on whisky down to 75% initially, and then to 40% over the next decade. If export volumes surge, it validates the UK's strategy. But if sales are held back by India's complex and varied state-level taxes, it will show that non-tariff barriers remain a major obstacle. So, what's next? Keep an eye on those quarterly whisky export numbers from the Scotch Whisky Association. They will be one of the first real indicators of whether this landmark deal is truly opening up the Indian market. We were just talking about complex trade relationships. Now, let's shift our focus to another economic partnership that's creating even more controversy. A £1.5 billion deal to build the UK's largest wind turbine facility is pitting massive economic opportunity against stark national security warnings. Chinese energy firm Ming Yang has announced plans for the massive project in Scotland, promising to create up to 1,500 jobs by 2028. The company's UK chief executive, Aman Wang, stated the goal is to make the country a global hub for offshore wind technology and support the government's mission to become a clean energy superpower. This raises a critical question about what superpower really means. The situation presents a fascinating duality. On one side, simply assembling products, while on the other, it exposes the challenge of building a truly sovereign industrial capability. While the Ming Yang plant will certainly create local jobs, it may also deepen the UK's dependency on China's established green tech ecosystem. This challenges the narrative of energy independence. The concern is whether the UK is becoming just a final assembly hub for Chinese-owned intellectual property and components, a model that is very different from the European Union's push to build a fully domestic net zero industry from the ground up. The promise of 1,500 specialised jobs also immediately tests the Scottish labour market's capacity. Interestingly enough, this highlights a critical and often overlooked bottleneck for the entire Western energy transition. The UK government's own reports point to a shortage in STEM skills and an ageing workforce. This means that capital and political will might be moving faster than the availability of a skilled workforce, potentially exposing a significant skills gap in advanced green manufacturing. The Scottish Government has welcomed the news, calling the proposed RCA port location strategically important for the growth of its offshore wind sector. However, if you zoom out, you'll see another layer of strategy at play. Conservative MP Nick Timothy has directly questioned the investment, pointing out that Ming Yang benefits from huge subsidies in China and that the plan is subject to serious questions about energy and national security. He previously urged the government to rule out investment from what he termed hostile states. The MP's mention of huge subsidies is not just a passing comment. It points to a major source of potential friction with the European Union. The EU has already launched its own anti-subsidy investigations into Chinese wind turbine manufacturers, concerned that they are undercutting European companies with artificially low prices. By welcoming a firm like Ming Yang, the UK risks being seen as a Trojan horse for Chinese industry. Wind turbines produced in Scotland could potentially enter the EU market with fewer barriers, undermining the EU's own trade protections and straining the delicate post-Brexit relationship. This puts the UK government in a difficult position. While one of its ministers said he would encourage investment, an official spokesperson delivered a more cautious statement, clarifying any decisions made will be consistent with our national security. Believe it or not, the Ming Yang deal is one of the first major tests of the UK's National Security and Investment Act, which came into force in 2022. This law gives the government the power to scrutinise and even block business deals in 17 sensitive sectors, including energy, that may pose national security risks. Therefore, the government's final decision is not just about one project, it's a crucial test of the UK's strategic autonomy. It will set a precedent for how the country balances its ambitious green energy targets against security risks, and it will send a clear signal to international investors about the UK's foreign policy alignment. The project now sits at a critical crossroads. When we place the £1.5 billion investment, promising a major economic boost alongside the pointed security warning about a subsidised foreign company, the contradiction becomes clear. So, what's next? The focal point to watch will be the UK government's formal review under the National Security and Investment Act. A decision to approve the deal could boost investor confidence and stocks in the UK's green energy sector, but it might also create trade tensions with the EU and raise eyebrows in Washington. A decision to block it would align the UK more closely with the US's hawkish stance on Chinese technology, but could slow its green transition. This single decision will define the UK's path forward, shaping its industrial policy, foreign relations, and energy future for years to come.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.